So yes, we were at concept of invoice price. So what are the benefits for the same? The consignee will not be able to assess the profit earned on consignment, and therefore therefore may not demand a higher commission. Okay, if consignee do not know that a real cost price was 100, our real cost price were 100, and we are generating the profit of 20, we are generating the profit of 20 on each unit without giving the information for the same to the consignee, means consignee is not entitled to any commission on that 20 rupees margin, on that 20 rupees margin we have just created. Okay, if the consignee know about the actual cost of goods, he may resort to some dishonest practice, such as buying goods for himself at a lower price and then selling them at a higher price in the market. It would give a fair idea to the consignee of the minimum price at which he is to sell the goods. He is to sell the goods. Calculation of cost price and invoice price. The margin I was talking about is known as profit. Means invoice price include both cost price and that margin which is known as profit. CP plus profit is equal to invoice price. And that also known as loading, as we have learned it in the previous classes. Let us take the different situation where the profit is given in the form of percentage and we have to work out the missing price. See, this is the equation. IP is equal to, means invoice price is equal to the cost price plus profit. This is the equation. If one is missing, you can find out the that thing. Okay, if two things are given to you, you can automatically find the third thing, that the missing part. If IP is given, see here, IP is given and you need to find out the cost price and the profit is also given. So you can just simply solve this equation. 200 minus 500, 200 minus 50 is equal to 150. That would be your cost price. Simply solving this equation can find one thing out of these two. So we have some different situation where the profit is given in the form of a percentage and we have to work out the missing price. Cost price is given and profit is given as a percentage of cost price. You have to work on invoice price. Second thing, if cost price is given and profit is given as a percentage of IP, you have to work out IP. Means two things needed to provide to you. If two things are here for you, you can solve the third thing or you can find out the third part. If IP is given, profit is given as percentage of IP, you have to work out CP. Let's just simply take the example first. CP is given and the profit is given as a percentage on CP. Just find out. Suppose the CP of a product, the cost price of a product is 200, which is invoiced at 20% profit on cost. 20% profit on cost. The IP will be calculated as follow. See, IP is equal to CP plus profit. It is our equation. We know that our cost price is 200. It is just simply mentioned in the question. We just put this 200 here. Now coming to the profit, for profit it is said that which is invoiced at 20% profit on cost. 20% profit on cost. So the 20% of the cost is 20 by 100 into 200, 40. 40 is our profit, and IP would be like 200 plus 40, 240. That's how we solve the equations. Directly going to the third point, IP is given and the profit is given as percentage of IP. Suppose IP of a product is rupees 500. IP is provided to you. Simply put it on under the IP section 500, and profit is 25% on IP. It is mentioned here that the profit is 25% on IP. So 25% of 500. Simply 1 by 4 of 500, which is 125. It is sold here, and this is the sold amount. And you need to find the CP in this question. Here, when you solve this equation, this profit would go here and turn into the negative, because here it was positive. When we send this thing to the left hand side, it will automatically become negative, because sign change from left hand side to right hand side. And the amount of CP comes like 375 rupees. And that's how we solve all other questions. 16.4, loading. Loading, which is also known as profit. You know that the invoice price is obtained by adding a certain amount of profit to the cost price. The amount of profit which is added to the cost in order to arrive the invoice price is called loading. Means if the cost we have created like 100 or 120, and consigner is selling the same at 150, so the profit would be 30 rupees. Means 120, 150 minus 120 would be 30. It would, this profit would, for 30 rupees profit would have been for consignee only. But for the consigner, the profit would be 50 rupees, because we have already added 20 rupees in the cost price of our product. That's how it is done. And those 20 rupees which we add earlier is known as loading. It is known as loading. So IP minus cost price is equal to loading. IP minus cost price is equal to loading. Here is an example. If the invoice price is rupees 10,000 and the cost price is rupees 7,500, the amount of loading will be loading is equal to IP minus CP, or the number of units into IP per unit minus CP per unit. So 1000 minus 700, 500, 7,500, simply the amount of loading comes like rupees 2,500. That's how it is done. That's how it is done. Items which involve loading. Items which involve loading. It involves opening stock, goods sent on consignment, goods returned by the consignee, and the closing stock. And the closing stock. How do we adjust this loading? Adjustment of loading. See, the cost price is 15,000. Okay. Invoice price is 18,000. So out of this, the loading is 3,000. Now the sale price, consignee have sale the same goods on 20,000. On 20,000. The difference between invoice price and sales price is 2,000. This is the loading of 3,000, and this is the profit without adjustment 2,000. The actual profit is 5,000. This is the same example I just gave to you for 100, 120, and 150. The example we took of 100, and the consigner have added 20 rupees as loading to create the invoice price of 120. Now the consignee have sold the goods for 150. Consignee have sold the goods for 150, means the sales price is 150. The difference between 120 and 150 would be 30 rupees, and difference between cost price and invoice would be 20 rupees. And when we add the both 20 plus 30, the profit comes 50 rupees. The same example we took earlier. Opening stock, the entry for the opening stock. Stock reserve account debit to consignment account, being unloading and opening stock. Goods sent on consignment. Goods sent on consignment. Same entry. Goods sent on consignment account debit to consignment account. Goods returned by the consignee. Goods returned by the consignee. Consignment account debit to goods sent on consignment account. Closing stock. The entry for the closing stock would be consignment account debit to stock reserve. Consignment account debit to stock reserve account. This is the entry for closing stock of unloading. Now, accounting for goods sent at invoice price. Accounting for goods sent at invoice price. We will see an illustration for the same here. Just read it out. Ramdas of Hyderabad consigned goods costing rupees 72,000 to Prakash of Cochin at a pro forma invoice price, which is cost a plus of 1 by 6th on invoice price. Remember that 1 by 6th on invoice price. The consigner paid rupees 1800 as insurance and other charges. Prakash received the goods and paid rupees 3,000 for freight and other charges. He was allowed 3% commission on gross sales. Three-fourths of the goods were sold at 33.33% profit on cost, half of which were credit sales. Okay, half of the balance was stolen, but the stock being insured, a claim was lodged for rupees 8,000 and was settled for rupees 7,000. Balance of stock was valued at pro forma invoice, write up the consignment and abnormal loss account. Let's create the account. First, consignment account to coaching account. Consignment account to coaching account means in the books of Ramdas Hyderabad consigners books. So the first entry would be like to consignment account debit, consignment to coaching account debit to goods sent on consignment. Goods sent on consignment. 86,400. 86,400. This is 72,000. This is the cost price. The invoice price, which is cost plus a profit of 1 by 6th on invoice price. 1 by 6th on invoice price. If we calculate this invoice price, the cost price was given us 72,000 rupees. Let's let's assume the invoice price be X. Okay, IP is equal to CP plus profit. This is the equation we know. Put it in the equation. X IP plus is equal to 72,000 plus 1 by 6 of X, because it is mentioned that the profit would be 1 by 6 of IP. 1 by 6 of IP means invoice price. So 1 by 6 of X, and this will come 5 by 6. When you solve the X part, it will come 5 by 6, 5x by 6. And when we send this item like 5 by 6 to the right hand side, it will reciprocal, it will get reciprocal. 72,000 into 6 by 5, and when you solve this amount, the amount you get is 86,400. 86,400, and we have put it same here. Okay, now coming to the expenses. The consigner paid 1,800 as insurance and other charges. So the entry for the same would be consignment account debit to bank account, because it is the consigner expense 1,800. We have mentioned it here. Now, Prakash received the goods and paid 3,000 for freight. 3,000 for freight. The entry would be consignment account debit to Prakash, because we need to pay it to the Prakash too. Consignment account debit to Prakash, 3,000. Okay. Now the sales. For the sale part. Uh, Sales means Prakash account debit to consignment. The Prakash have made some sales of rupees 72,000. And how we have calculated it? Let's go back to working note. See here. 3 by 4th of goods sold at a profit of 33.3% on cost. Goods were of 72,000 and 3/4 of those goods were sold. So only 54,000 rupees goods were sold. And the profit on the same would be 33% of cost. 33% of cost. When you solve this, when you put 33% of 54,000, the amount you get will be 18,000. It will be 18,000. And when you add the goods value and the profit, when you add both of this thing, you will get the sales amount, which is of 72,000. That's how we have calculated the sales. And the entry for the same would be Prakash account debit to consignment account. We have put it this amount 72,000. Now, Prakash was entitled a commission of 3% on gross sales. Gross sales we have made for 72,000, and 3% of 72,000 would be 2,160. And the journal entry for the same would be consignment account debit to Prakash. Consignment account debit to Prakash. Okay. The loss also, we have faced some loss. So abnormal loss account debit to consignment. Abnormal loss account debit to consignment 9,600, because half of the balance was stolen but the stock being insured. A claim was lodged for rupees 8,000 and was settled for 7,000. After putting the loss, we just need to calculate it. We have left the goods unsold for worth rupees 11,400, because some out of them was stolen, some of the good were sold, and this is the left stock, means unsold stock. The stock reserve account, consignment account debit to stock reserve account, means loading on closing stock. Loading on closing stock, 1800 rupees. 1800 rupees. This is the loading goods sent on the consignment account. We have added this amount as loading, and this is the stock reserve account, loading on closing stock. And when you calculate both the side, when you add both the side, it will show a credit balance. It will show a credit balance, and the debit side will be short of 12,240, and you will put this amount under the name of profit and loss account. It is a profit. It is a profit. This is the abnormal loss account. It's just simple. You just need to put the journal entries into the ledgers. That's how we create an account. And with the same, we have completed this unit as well. Now we will be moving toward the last unit of this block, which is joint venture accounts. Joint venture accounts. So what is a joint venture? When two or more persons join together to carry out a specific business venture and share the profit on agreed basis, it is called joint venture. Suppose it is generally on consignment or sales or purchase or construction, things like this. Suppose you get a order. Okay, you get a order to construct a building. It's a project to construct a building. Now you have joined, two companies have joined their hands for the construction of that building. That thing will be known as a joint venture account. When two or more persons join together to carry out a specific business venture and share the profit on the agreed basis, it is known as joint venture. It is known as a temporary partnership. It's the another name for joint venture. It is called temporary partnership. because partnership goes for a long run, okay, but this joint venture will demolish itself whenever whenever we accomplish or complete the task which was given to us. Whenever we complete the task or construction or our business, this joint venture will demolish by itself. Features of joint ventures are: it is formed by two or more persons. The purpose is to execute a particular venture or a project. No specific firm name is used for joint venture business. It is of a temporary nature. Hence, the agreement regarding the venture automatically stands terminated as soon as the venture is completed. Means as soon as your project get completes, the joint venture or the agreement will demolish or will be terminated. The co-venture share profit and loss in the agreed ratio. However, in the absence of any other agreement between the co-ventures, the profit and losses are to be shared equally. During the tenure of joint venture, the co-ventures are free to continue with their own business unless agreed otherwise. The main advantages of a joint venture, the main advantages of a joint venture. It is sufficient resources because two companies or two persons are joining their hands. If one person is not able to complete a building or construction of a building, but two or more persons can. So sufficient resources like funds and other stuff, ability and experiences. Many people, many experience, many ability. Not every single person have all the ability of work like planning, management. No one single person can perform all the activities or can have all the abilities. Spreading of risk, spreading of risk. Joint venture and consignment. Let's see the difference between joint venture and consignment. Consignment. Normally two person are involved, the consigner or consignee. But in joint venture, co-ventures is usually two or maybe more than two. The relation between consigner and consignee is of principal and agent. But the relation between co-venturers is of partnership. It is of partnership. The arrangement may continue for a long time. Consignee or consigner relation could go for a long time. But once an venture is completed, the relation also comes to an end. The funds are provided by consigner only here. In consignment, the funds are provided by consigner, but in joint venture, funds are provided by co-ventures. Consignment. The consignee act merely as an agent and he has to follow instruction of the consigner. But in joint venture, the co-venturers have equal authority to take decision. If you are the partner, you can make a decision. Consignment is generally concerned with the sales of movable goods, but joint venture may be for sale of goods, for carrying on any other activity like construction of building, investment in shares, and etc. The profit belongs to the consigner only. In the consignment, profit belongs to the consigner only, and consignee will get commission. But in the case of joint venture, profit belongs to all co-ventures as per their share. As per their share. In the consignment, consigner owns the good. In joint venture, there is a joint ownership of all resources. That's the difference between consignee and joint venture. Now, accounting treatment for the same. Accounting treatment for the same. In the books of one co-venture or in the books of all co-ventures. In case the business is not very large, only one of the venture may be entrusted with the task of recording the transaction in his books. Means not if suppose if they we have three joint venturers, three co-venturers A, B, and C, and business is not very large. We have got a small project. Then only one out of those three will create books of accounts or maintain all the recording of transaction. In books of all the co-ventures, if the project is big, then each and every co-venture will write down the activity or record all the transaction in their books. Memorandum joint venture account. Sometimes each co-venture records only transaction as are directly concerned with him or with them. In that case, he cannot work out the profit or loss because his books do not include all the transaction of joint venture. Hence, for calculating the profit and loss, in this case, for calculating the profit and loss of joint venture, a memorandum of joint venture account has to be prepared. Means memorandum of joint venture account where each and every activity is not mentioned by the co-venture, but all activities related to the profit and loss will be mentioned here. Separate set of books. Separate set of books. Sometimes for the sake of convenience, a separate set of books are maintained for the joint venture. Under this system, a joint bank account, a joint venture account, and a personal account of all co-ventures are to be opened in the independent set of books of accounts. Let's read how we record in the books of one co-venture. In the books of one co-venture. When the co-ventures send their contribution, suppose A, B, and C, okay, they have agreed on a project and become co-venturers. Now only B is creating the books of account. Okay, B is maintaining the books of account. So how he will record the journal entries for the same? The first entry would be when the co-venturers send their contribution, means A and C are sending their contribution for the project. Cash or bank account debit to co-venturers' personal name, means cash account debit or bank account debit to C to A. If both are sharing to to A and C. When the goods are purchased for the joint venture, goods are purchased for the joint venture account debit, to cash or bank account. And the goods are supplied from his own stock by the co-venturers who is recording the transaction, means B. Goods are supplied from the B's factory to the joint venture firm. In that case, he will pass the general entry like joint venture account debit, because goods have been added to the firm of joint venture account debit to purchases account. When the goods are supplied by other co-ventures, means joint venture account debit to co-venturers personal account. Suppose C have sent some goods to the joint venture firm, the entry would be joint venture account debit to C's account. When some expenditure is incurred on account of joint venture, some expenditure is incurred on account of joint venture account debit to cash or bank account. If any person or any co-venture is paying for the same, the entry would be joint venture account debit to co-venture's personal account. Suppose A is paying for some expense on behalf of the joint venture firm, so the entry for the same would be joint venture account debit to A's account. When the co-venture recording the transaction sells the goods, means B is recording the transaction, B is maintaining the books of account, and he sells the goods. And if he have sold the goods for cash, the entry would be cash account debit to joint venture account. But if he have sold the goods On credit, then the entry would be debtor's personal account debit to joint venture account. To joint venture account. When cash is received from the debtor's cash or bank account debit to debtor's personal account, this is the same entry we used to do for debtor's cash. When some cash discount is allowed to the debtors making payment or some bad debts are incurred, joint venture account debit to debtor's personal account. When the sales are made by the co-ventures personal account debit to joint venture account. When some cash or bills receivable are received from the co-venturers on account of sales made by them. So in that case, cash account, either bank account or bills receivable account debit, whatever we receive, to co-venturers personal account. To co-venturers personal account. When the co-venturers recording the transaction is entitled to some commission or salary, suppose if B is maintaining, if B is maintaining the books of account and he is entitled to any commission or salary for the same, the entry for the same would be joint venture account debit to commission or salary account. When the unsold stock of joint venture is taken over by the co-venture recording the transaction, purchases account debit to joint venture account. Purchases account debit to joint venture account. And in case of co-ventures personal account debit to joint venture account. If if the books of account shows a profit, the entry would be joint venture account to P&L account. And if there was any loss, the entry would be P&L account debit to co-ventures personal account debit to joint venture account. That's how it is done. Recording in the books of all co-ventures. Second method, all the transactions related to the joint venture are recording in the books of co-ventures. In order to complete the joint venture account in the books of all co-ventures, each co-venture send the necessary information about his or her dealings to the other co-ventures. There is not much of difference in recording of transaction between the first and second method. We will be having similar entries in the joint venture account in each co-venture's book, who shall all open the personal accounts of the other co-venture. Look at the illustration number 3 to clearly understand the recording of transaction under the second method. Let's take this example for better understanding. Here, Arvind and Bablu. Arvind and Bablu entered into a joint venture agreeing to share profit and loss equally. Okay. The following transaction took place during the course of venture. First, Arvind bought goods for cash rupees 2550. Bablu bought goods for cash 7,000. Arvind paid storage charges rupees 500. Bablu paid freight and insurance of rupees 800. Bablu sold goods for cash of rupees 7,000. Bablu received 3% commission on sales, that is of 210 rupees. Sales made by Arvind, it is of 5,000. Commission payable to Arvind is 150 rupees. Bablu took over the unsold stock, it is of 560. Prepare the necessary ledger accounts in the books of Arvind and Bablu, assuming that the accounts are finally settled between them. So, ledger of Arvind, joint venture account in the ledgers of Arvind. So, how he will pass the entry? Joint venture account. First, goods purchase. See the entries of Arvind only. Arvind bought the goods for cash. The entry for the same would be joint venture account debit to cash. Joint venture account debit to cash 2500. Okay. Arvind paid storage charges of rupees 500. Again, joint venture account debit to cash. Joint venture account debit to cash. First, only see the Arvind's entry. Now, Sales made by Arvind. Sales made by Arvind is of 5,000 rupees. Means the entry for the same would have been cash account debit. Cash account debit to joint venture account. To joint venture account. And here is the entry for the same. Cash account debit to joint venture account. Now, commission payable to Arvind. Commission payable to Arvind is of rupees 150, means joint venture account debit to Arvind. Joint venture account debit to Arvind, or to commission, you can just write. Commission account 150. Okay, now coming to the Bablu part. Bablu bought goods for cash. Bablu bought goods for cash. So the entry for the same would be like joint venture account debit, joint venture account debit to cash. Sorry, it should not be cash. It is the ledger, it is the books of Arvind only, na. So that's why we just need to mention the name Bablu, because these are the account of Arvind. These are the account of Arvind. We can mention the name of Bablu here. So joint venture account debit to Bablu. Goods purchased of 7,000. Now, Bablu paid freight and insurances of rupees 800. Again, joint venture account debit to Bablu means the expenses he have made of rupees 800. 800. Bablu sold goods for cash of rupees 7,000. Bablu account debit. Bablu account debit to joint venture. Bablu account debit to joint venture. By Bablu means sales, we have mentioned it. This is the amount of sale, 7,000. Bablu received 3% commission on sales. So joint venture account debit to Bablu, and please put a commission in the bracket so we can find out why we are entitling 210 rupees to Bablu. And again, Bablu took over the unsold stock. Bablu took over the unsold stock. For the entry for the same would be Bablu account debit, because Bablu is taking the unsold stock here. Bablu is doing drawings here. Bablu account debit, Bablu account debit to joint venture account, to joint venture account. And here is the entry 560, 560. When you calculate both the side, it will show a credit balance, means credit side is bigger than the debit side. And to create a balance between both debit and credit side, you need to add this 1400 amount, this 1400 amount under the name of profit, and this should be distributed between Bablu and Arvind, because these are the ledger, these are in the books of Arvind. We just mentioned P&L account, we just put it in the P&L account of Arvind. And here this 700 rupees will be, this 700 rupees will be transferred to the Bablu's account. And why it is 700 and 700? Because there is not mentioned any kind of profit sharing ratio. If any kind of profit sharing ratio was mentioned here, then we need to distribute it according to the profit sharing ratio. But here it was not mentioned, so we are distributing it equally. If profit sharing ratio is not mentioned in any question or any case, then it means you need to distribute it equally, you need to distribute it equally. And in the Bablu's account, in Bablu's account, the entry would be, in the ledger of Bablu, the entries would be opposite. Okay. In Bablu's ledger, Bablu will not mention his name, but he will mention the Arvind's name. That's it. That's the difference. Now we will see the memorandum joint venture account method. Memorandum joint venture account method. So A purchase goods for cash. So the entry will be, see, A and B have entered in a joint venture and some transactions have took place. A purchases goods for cash. So joint venture with B's account debit to cash account. Because this transaction shall be recorded in the books of A only, because A have purchased the goods for cash for joint venture company. So the entry would be joint venture with B account debit to cash account. If B have purchased some goods for cash, the entry would be joint venture with A account debit to cash account. Second thing, A incurs some expenditure on account of joint venture, means joint venture with B account debit to cash account. B sells goods for cash, cash account debit to joint venture with A account. B send money to A. It shall be recorded in the B's book as follow. If B is sending some money to A, so the entry for the same in the B's book, in B's books of account, joint venture with A account debit to cash account, and in the books of A means A is the receiver of cash, so the cash or bank account debit to joint venture with B's account. These are the simple entries we need to pass in memorandum of joint venture account. And with that, we have completed this block. With that, we have completed this block, and in next class, we will be doing next block, the last block. So I'm concluding this class here only. We need to practice these questions.